Understanding what type of day you're in is very important. You know, days like the 3-day cycle, the first red, first green day, there's different types of signal day templates, the different kinds of 3-day templates, Monday, Tuesday, Wednesday, Wednesday, Thursday, Friday. Understanding those things are very important and very beneficial. However, if you don't have a basic understanding of not only structure, but also, you know, some price action tips, and you're just focusing on, well, it was first green day today, or yesterday, so now today it should go up, you're really limiting your success and also your accuracy. So in this video, I'm going to walk you all through how I frame every single trading day in order to achieve a better accuracy than just assuming based off of what kind of signal I received on the previous day that the market will do something, and being able to adapt to what kind of day is currently playing out, so that way I can still get good trades. And if you want to follow along with this slideshow, it is linked down in the description below, as is all of my videos. I'm taking a brief pause from the beginner series, and if you are interested in that series, you can find that playlist on my channel as well. So let's get into some of the big mistakes from people sending me questions and YouTube comments and things like that, and sending me charts of trades they've taken. Some of the most common things that I am seeing is people have a understanding of the different types of days, whether that be first red, first green, you know, the breakout days, 3 days of breakouts, whatever it may be. But then on the day itself, they are failing to really study price action, and they're just assuming that the market's going to do something. So whenever you get a really convincing bar, that's the bar that they're taking, and when in reality, the structure of the market or something like that is doing something completely different, and they don't see it, or they just don't understand it, and they're getting caught up in some counter trend moves at the extremes, and it's punishing them. Understand the different types of days, understand price action, but then not following the plan, right? They understand both, but then their own emotions kind of come in and they just want to take trades. That's a pretty obvious one. Not truly understanding either. I think that's a really big one as well. Maybe you feel like you've got it, and then one bad day, and then it kind of starts to tumble downhill. Not understanding market structure. That is a huge one. Understand that the market is fractal. Monthly chart could be in an uptrend. The daily chart could be in a downtrend. You know, all these different trends and things. Which ones are important? Which ones truly matter? Do any of them matter? We're going to talk about that in this video as well. After understanding the basics, then they try to overcomplicate with a bunch of extra stuff that in reality, you know, you really don't need. They send me these charts of their trades that they've taken, and all I can see is the stuff that's on their chart and not the actual most important thing on the screen, which is the bars and the levels, previous day's high and low, the high and the low of the current day. I try to keep my rules for structure really simple, and also to find the most accurate swings, so that whenever there is a break in structure and, you know, maybe a structural change is about to occur, I can rely on those structural shifts a lot more than if maybe that's just like a little itty-bitty range and then that structure breaks and it's like, okay, is it going to reverse? But it really doesn't. Those things can be really confusing if you don't have solid set-in-stone rules. So let's talk about a one-bar range real quick. So if I have a downtrend and the market's making lower lows and lower highs, we get a bar that comes down like this, and then the follow-on bars, maybe the wick goes through the previous bar's low, but doesn't actually close lower than that bar. You know, the bar could look like this, and then you get a bunch of follow-on bars that are still on the inside of that one bar's range. That is not going to be a solid or a decent swing point until they get solid closures above the high of that bar, okay? So in this scenario, I'm going to wait for them to break above that bar, and then I can now use this as a swing low, all right? I just want to point that out because people send me a lot of charts, and it's a one-bar range, and they're trying to use that as a swing point, and those are not ones that I typically will use because I don't find them to be nearly as reliable. Same thing as if I was in an uptrend. If you get a one-bar range, something like this, where the bar is up, and then there are some bars in between, but all of those bars are still closing on the inside of that previous bar, I am going to wait for a solid candle to close below that bar's range, and then now I can use this as a swing high in order to continue to track my structure. All right, so let's go over some other rules now for structure. That was just to kind of go over the one bar range, and I've got pictures of all these things. I know it's a lot of words on a screen, so bear with me. But let's go over the words real quick, and then we'll apply it using pictures. Okay, so in an uptrend, we're making higher highs and higher lows. Just start off with a high and start off with a low. Find the most obvious ones. And when structure is broke to the upside, so they've broken out of a bar's high, all right, or the swing high, the body of the candle needs to close above that level. I don't use the wicks as a structural break. I want to see the body of the candle close above that previous bar's range, or that previous swing level. Then once the market pulls back in 2 bars, so I have a bar that breaks the level, and then I have 2 bars coming back down, and of course remember the 1 bar range rule, so make sure that still applies. But as I'm going through this, let's just always assume that when I say 2 bar pullback, I'm assuming that they have broken down, past that range. Okay, so we get 2 bars pulling back, and they do not have to be consecutive. It could be 1 bar down and then like a doji bar, maybe an up close bar and then another bar down. Like, that's all fine. I just want to see 2 coming back down in order for me to then draw this little line up here. All right, so now after I get my second bar down, I've identified that is the swing high currently. That is the high that is in place. It could come down here and go into consolidation or do whatever. It doesn't really matter. As long as it is still trading in between the most recent low and the most recent high, I don't have anything else to do. Now, once that swing high is broke with a solid candle close above, the body of the candle closing above that level's high, I can now identify my new higher low. So I would take wherever I drew that line and I would find the lowest place that the market pulled back to, and then I would attach it to where that bar broke, and that is where you can now draw your higher low. This is very important for when I am tracking structure going higher. If I'm looking for a short trade on the day and they break down, now I can objectively or somewhat objectively say, yes, they have broke down, and I am now looking for a pullback for me to get into the market. And the same rules are going to apply if I'm in a downtrend. Everything I just set up here is applied just in reverse. So if we have a downtrend, we're making lower lows and lower highs, and then we get a 2-bar pullback. Remember that we're assuming that 2-bar pullback has gone outside of that bar's range. Once I get that second bar, I'm going to draw my low in place, and then once I get a solid bar's close below there, I'm going to draw my little U, find the highest place that the market pulled back to, connect it to where that bar broke, and I'm now going to identify my lower high. For both situations, whether you're in an uptrend or a downtrend, this process will just continue until a higher high is made if you're in a downtrend, or a lower low is made if you are in an uptrend. And these things can signal that either a trend reversal is about to take place or that the market is going to go into consolidation. Both of those things should definitely be strong considerations whenever you see them. All right, now this is a very clean trend. Obviously, it's not always going to be this perfect. It's not always going to be this great. But if you have practice and you have some experience with the rules for this structure, it actually becomes a lot more simple. But I have used a somewhat cherry-picked example of a very nice clean trend. So I'm just going to point that out right off the bat. But anyways, so going back to the starting point, right? So we talked about finding an obvious high and an obvious low. I just chose to use the beginning of the day. So I chose this high and I chose this low as my starting point, and then the market breaks down. So this was the first example of that 1-bar range that I was referring to. This bar closed lower than the previous bar, and it created a high and a low range. And then you notice how all of these other bars in the middle here did not close lower than that bar or higher than that bar until right here at this point. So I would not have chose to use this as a swing low until these bars started closing above that bar's high. But once that closes above that bar's high, I can grab this and draw this line across and use that as my lower low. Now, I still got my starting point high up here, so this is just going to maybe turn into a lower high unless this breaks. So it trades back up. Now, I don't know that this is going to be a lower high until this candle here closes lower than that lower low. So we get 1 bar closing below the previous swing low. The body of the candle is definitively below that level. So now what I can do is say, okay, this is where the low is created. Draw that U and down to, oh man, my computer just did something crazy. It's all right. Up here, this is the highest place that the market had pulled back to prior to this bar closing lower. All right, so I would take this, I would draw that line and say, okay, this is my lower high now, and I can use that as my structural level. So we're going to repeat the same process now. This bar did not close. Again, 1 bar range. They just keep going lower, and that process is going to repeat until we get an actual pullback. So 1 bar range, a bunch of bars penning through the low, but not closing lower. But then they do start closing higher than that bar's range over here. Okay, so we got some closing higher. That's good, and I can now use this as an actual low. I draw that line. Market continues to pull back. Remember, we're trading in between this high and in between this low, so everything in the middle is somewhat irrelevant until that low breaks. So this low has been broken with, again, a body of a candle closing lower than that level. So I repeat the process. I'll draw my little U from here to here, identify that that is the highest place that the market pulled back to before the new low has been broken. So I draw my high, and then I've boxed this off to show this because let's just take a look. This bar didn't pull back. So this is a down closed bar. This bar traded within that previous bar's range. It went lower, but did not close lower. Same thing here. We're still on the inside of this bar's high and low. Now this bar has gone lower, except again, the same thing has happened over here. Still no 2-bar pullback. Same thing here. This is 3 bars back up, but it's still on the inside of this bar's range, which means it's not necessarily, at least in my opinion, not a good swing level to be using for structural breaks. So I'm not doing anything in this range. I'm just going to let the market continue to do its thing. And it continues to go lower, and then now we can finally start to identify new levels, right? So we come down, notice this bar traded higher than this previous bar here once, and then twice. So notice that these bars weren't consecutive. We got a pause bar in between, but this bar did go higher, so 1 and then 2. So now I can draw my new swing low, and then I don't know that this is going to be a high until it breaks down over here. We've got bodies of or a body of a bar closing lower than that swing low. So now I can draw my U and figure out where was the highest place that the market has pulled back to, and it's right here. So now I have my lower low, my lower high, and again, that process will continue to repeat until they make a higher high, which could indicate a change of direction or that the market is about to go into consolidation. Now that we've identified some rules for structure, we can start to go through the process of identifying what kind of day you're currently in. And first, you're going to need to identify your signal, because this style of trading, it's always based off of the previous day or the previous 2 days. So, knowing what day you're in within the 3-day cycle, what day of the week it is, Monday, Tuesday, Wednesday, Thursday, Friday, or what kind of signal day you received on the previous day, first red, first green, inside day, narrow range days, 3 days of breakouts, things like that. And I have a whole entire playlist here on my channel that you can watch to learn what types of days these are. If I did them all in this video, it would be like 45 minutes and probably longer. So you can check that out on my channel. Just click on the playlist section, or you can go over to Stacey Burke's channel and watch his videos as well, because that's obviously where I learned these from. So here's the link to that playlist here. And like I said, Stacey Burke's channel. You just type in Stacey Burke on YouTube. All right, so we're going to figure out what type of day we're in first. You watch other videos to learn that. And then we're going to go on to framing the day that we're currently in order to figure out if we are in an ideal template for one of these to actually play out. Now that I've identified what type of day it was yesterday, and I'm trying to look at today, just from this example that we have in front of us, the market had been going higher and higher. We're on the front side of a move, making higher highs and higher lows. And then it breaks this fancy, super, awesome trend line here. It breaks down. And we got day 1 of the 3-day cycle. They attempted to break higher at the high of the current week, and it failed. It went lower, and then it broke out of the previous day's low over here on this day. So we would have a day 1 of the 3-day cycle, and also a first red day. They attempted to go higher at the high of the current week, and then closed below the closing price from the previous day, or the opening price for that current day. Okay, so we've got day 1 and first red day. Now we need to try and figure out what type of day is this, and is it actually going to be relevant or important for us to start to trade. So looking at the day itself, you could just kind of look and see that maybe this is my starting point, this high and this low over here from Asia. And then we've made a lower low, and then we pulled back in 2 bars. So this bar here was higher than the previous down closed bar, and we got our 2-bar pullback, and it's making lower lows and lower highs. That's important. Number 2, we have a kind of a bear channel. They're just going lower. Could be a parabolic channel to the downside. And as it's continuing to make lower lows and lower highs, we get a breakdown outside of the channel and a pullback. And then, of course, the timing within the day is super important. So timing, 9:30. Everything is lining up great. I've got a little checklist over here for you to kind of look at price action, peak formations, levels of rise or fall. Market only does three things: breakout, trend, breakout, reverse, or stay inside of a trading range. We've broken out of the previous day's range, so we're not in a trading range at this point. On the day itself, we're making lower lows and lower highs, so we're not in a trading range. We're breaking out. We're making lower lows and lower highs. That's really good. And also, timing of day and things like that, we are now looking at 9:30. And this was the NASDAQ, so this is an index, 9:30 being the most important time. This is another example. This is the NASDAQ on a 15-minute chart. So looking at this has done a 550 pip range. This is the Thursday, pretty much super wide range day. All right, this was an outside day. They hit both sides of the previous day's range. And then that followed by an inside narrow range day on this day here. And then we got a breakout day that closed outside of the previous day's range, outside of that inside day's range. And then on the following day, it actually broke down. So now we've made a lower low back down on the inside of the week's range. This is the opening range for the week, Monday. And we're starting to make lower lows and lower highs. And then it pumps back up into the high and then breaks down, makes another lower low, pulls back right into the beginning of the New York session. So a market that is maybe, breaking out to the upside. We could say, arguably, right, that maybe this is going to break out and do a range expansion of that narrow range day, except instead of breaking out and pulling back and continuing to trend, one of those three things that we just looked at 2 slides ago, one of the three things that markets do, it's actually broke back down on the inside of the day's range and is making lower lows and lower highs coming into the New York session. So instead of looking for the range expansion, I could start to look for the reversal trade coming off the high of the week. And we've got all of this space to fall back down to previous day's lows and maybe even the low of the previous week, which obviously in hindsight is great. It did do both of those things. But that's kind of the thought process with framing the day. It's either going to do one of these two things based off of what the previous day has done. In this case, it would have been, it could either do a range expansion to the upside, but that's not what the day itself is actually showing because we're making lower lows and lower highs. So instead, I am going to look to trade the reversal coming off of the high of the current week back down to previous day's lows and back down to maybe, if you want to hold on, for previous week's low as well. And I've actually listed out that thought process here with steps to frame the day. So does the day's price action and structure match the signal that has presented? So like I just showed on that previous slide, you have an inside day. There's a potential for a breakout and a failure going back to the other side of the range, or a breakout of that inside bar, a breakout pullback for a range expansion of that inside bar. In that case, it would have been to the upside. So I'm looking at what was yesterday, what was the previous 2 days, and then what has today done, and then making I'm not going to say a guess, but a informed decision based off of what the day is doing and what yesterday has done, and then applying that to the session that I'm trading. So first red day. The market continues to make higher highs and lows throughout the session. I'm talking about the current day. More than likely, breakout of structure to the upside or even in a range without breaking down. So thoughts. I need to wait for price action to confirm my idea. I'm not going to just guess a direction just based off the signal day alone. I need confirmation on the day. So what this is saying is yesterday was a first red day, but then I come to the screen today and it just keeps breaking out of structure, keeps breaking out of rectangles to the upside, and just continues making higher highs and higher lows. I'm not just going to guess or say, oh, well, it's going to go down today, so, it was first red day. No, I'm going to wait for that confirmation, especially in a market making higher highs and higher lows. I'm going to wait for them to make a lower low first, and then on the pullback, that is where I will look to get in because that's the more high probability entry, and also the entry that is timed better instead of just guessing where the high is or, trying to pick the top. Inside day. The market breaks out of an inside day in the first hour, but has been stair-stepping up to the level. So understanding price action. They had maybe a consolidation down low in the day's range and then broke out of that, or even from the previous day, maybe end of day consolidation, and it started to stair-step its way all the way back up to the previous day's high, and the previous day was an inside day. We get up to that previous day's level at a certain time of day, maybe it be 9:30 New York or something like that, and it breaks out of that and fails. So it breaks out, and then you automatically get a sharp reversal back down into that inside bars range. Well, now we're looking at something different because it could still maybe be a breakout pullback. So I'm going to look at structure. I'm going to look at the time of the day. And I'm going to watch price action to determine whether or not I should be taking this reversal. But thoughts, will the breakout succeed? Is the time of day and price action confirming my idea? Maybe the breakout will fail. I should wait for it to fail for confirmation and wait for structure to change to lower lows and lower highs in order to not get caught in a squeeze higher, which is pretty much what I just said. So I would wait for a lower low. It breaks down, it pulls back, and then I can look for, again, price action, maybe like a little double top M or some kind of pattern up here. When it engulfs back down to the downside, now I have all this space to get back down to here and also maybe to continue making lower lows and lower highs back down to the low of the day. Number 3, 3 days of breakouts. This is probably the most commonly asked thing where people see 3 days of breakouts and they just assume, well, tomorrow I'm going to go long or I'm going to go short. But that is certainly not the case, especially when the market is breaking out constantly to one side or the other. That could be some kind of extended run or larger time frame range expansion, and you're trying to counter trend a larger pattern that you don't really maybe see because you're down on the 15-minute chart or something like that. So thoughts, I should wait for 2 to 3 leg pullback. Ideally, this pullback should be 25 to 50 pips, depending on volatility of that instrument. Then I will wait for some kind of chart pattern and a breakout of that pattern for my entry, 1 minute or 5 minute. So what this is saying is, if we're breaking out to the upside, so we're breaking out previous day's highs, making higher highs and higher lows, I really should be waiting for, on the day itself, for them to make a lower low. Okay, so if they break down, they make a lower low, and then I get some kind of pullback. Now I can look for them to make that second breakdown for me to actually look to take my trade entry instead of just saying, well, it's broken out 3 days. So I'm going to try and find the top and sell that. That is in my opinion, and from my experience, very low probability. I would much rather give up some space or some money from, trying to sell the top, because this is a lot more reliable and a lot more high probability compared to just trying to find the top. And this is where my confirmation is coming from. So this is a really good example of where you might be getting caught thinking, it's pumped up really far and then we get a first red day and, why did this continue to go higher and things like that. And that is the point of framing the day and understanding price action and structure and things like that. In a market that's making higher highs and higher lows, it's best to just trade with the trend. The trend is your friend until the end, until you get a reversal. And it needs to be a strong reversal, and there needs to be clear signs and things like that. So, for example, this is making higher highs and higher lows. There's been no trend line break or anything like that. We've just been making higher highs and higher lows. And we get a first red day, right? So they pumped up 300 pips. This is perfect as far as I'm concerned. They broke out of the opening range breakout. They've gone 300 pips, so I have 3 levels of rise outside of a breakout. And then you get a first red day, and it's like, okay, well, tomorrow I'm going to look for a short trade. Absolutely, you can. But for me personally, if it starts making lower lows and lower highs, or it pumps back up to the high and then breaks down, something like that, or along those lines. But in this case over here, it just continues to make higher highs and higher lows. This was also a narrow range inside day, and it's broke out. Again, going back to the 3 things that markets do: breakout trend, breakout reverse, or stay in a trading range. This is very clearly breaking out to the upside. It's breaking out in hindsight. It's breaking out prior to the New York session. We've broken out. We've made higher highs and higher lows. Up until the New York session, it still has not broke down yet. Now, we got some news in here that spiked up and spiked down and then pulled back, and this is continuing to pull back. But this is a high here, and then your low is still all the way down here. So technically, this is all just in consolidation, and then it trades down into the low of the session. Again, this is the previous day's high in a market that's in breakout and possibly doing a range expansion to the upside, not only of the opening range, but also this inside bar that we had on the previous day. They broke out of that, and then it breaks out and continues to go higher, which, again, in hindsight, you can see that they did do that expansion of that narrow range day to the upside. But again, just because you get a first red day or something like that, it is very important to understand price action, because I of the belief and of the understanding price action is above everything else. And regardless of what your signal is, the price action on the day and structure of the day is going to be far more important to me to keep me from trying to just assume that something is going to do something just because what the previous day has done. This is that chart from the previous slide, except this is now down on a 5-minute chart. This is the NASDAQ. And on the day, like I said, making higher highs and higher lows. We've broken out of the previous day's high. London has made a higher high and started to pull back, but they're just pulling back into the breakout level. Then we get this big news event, and they slam it back down into that level. And kind of a 3 push pattern, 1, 2, and 3 down into the low, down, up, down, and then they engulf back up to the upside. There's the EMA engulfment, and then break up. So now we're still making higher highs and higher lows. Again, very important just to not just go into something and assume that it's going to go back down just because look at this. Look how big this bar is back down, but we're still making higher highs and higher lows, continuing to go higher and higher. So question to myself, maybe the breakout could fail, because it could. This absolutely could fail. Would want to see it fail and still need to see a lower low. So I would need to see a lower low and a lower high. And on that lower high, the first lower high that gets put in place, that's where I would look to take this trade. There's a 50-50 chance this thing just continues to trend higher because of the range expansion of the previous day, the fact that we're in an opening range breakout, the weekly template, and we could be doing a range expansion of that opening range. And also with this slide, I understand that I put the higher low here, and I just want to reinforce that this is a 1-bar range, so even though we've pulled back in 2 bars, this technically is not really a higher low, but really just for the illustration of a market that's still making higher highs and higher lows. They have not broke down yet. All right, so we're down on the 5-minute chart. This is that example of the first red day. So we had the first red day yesterday, and now we're trying to figure out what we're going to do today. We're making lower lows and lower highs, and it's pumped back up into the high 75 pips. The average pullback, 25 to 50 pips, 75 pips being 3 levels of rise. They've come 3 levels of rise off of the low of the current day and also the previous day, and then gone back into consolidation. All right, so we've pulled back and we've started to break down. Again, looking at price action patterns, there's a micro double top, up, and then an engulfment down. We're starting to break down and pull back. Again, breaking down and pulling back. This is an inside bar. So a bar that closes lower, a breakout bar, and then an inside bar, and then a breakout bar. That's a really good pattern, and one of the ones that I really like to use for my entries. I just go down on a little lower time frame and find number 1 in this 5-minute pullback on the 1-minute chart where it starts to break down, and I use timing in order to do so. So if I get a 1-minute engulfment of a price pattern at the close of this bar and opening of the new bar, that's really good. I can do that on the 1-minute chart, or I can just sell below this bar and with the belief that it should follow through and start going vertical from that point. And then this is the price action from that first green day that we saw, where it had made the higher high and then pulled back in the 3 legs or the three pushes. It's also done 3 levels of drop, 3 levels of 50, 50, 50, and 50, 150 pips off of the previous day's high, and then has been coming back down. So it goes into consolidation between a high and a low, and then it breaks out to the upside. And then over here, looking at the candles, this is a 1-bar range. And then this bar's low is higher than this bar's low. That bar's low is higher than both of those. This bar's low is higher than this one. So we have very little to no overlap in the bars, and it's created sort of this parabolic channel. This is another entry that I really like to take, either within the channel or after it starts to break out. I go down on a lower time frame and try to finesse a better entry, but sometimes I will just take the 5-minute entries. So if you want to do that, great. Here's an engulfment. There's a pin hammer. There's an engulfment. There's a pin hammer. Whatever you'd like to do. But this is really ideal price action after a first green day. The other one was good price action, in my opinion, after a first red day. And I am going to come back and do a much more in-depth video about entries, and I'm just going to include that into the series that we're already doing. And I've got about 1 or 2 more videos of that series. And one of those videos is going to be solely based off of entries. Nothing to do with signal days, nothing to do with anything else, just going over price action and the types of patterns that I look for in order to find entries and then where I'm putting these targets. Hopefully this video has done at least something for you in order to help you frame your day, your trading day, and hopefully it will make you a little bit more accurate. Again, the slideshow is down below, and also the link to my free Discord so that you can ask questions. I hope you all have a great weekend, and I will see you in the next one. Bye-bye.